All right, guys, welcome back. Economist Harry Dent thinks gold will fall 50% from here. Now, this was an interview done with Kitco News back on November 1st of 2017. Though it was done then, Harry Dent still feels that gold will be deflationary because of its tie to commodities. Now, I think that there will be slight deflation before a hyperinflation. Harry actually thinks there's going to be a long deflation that will happen. I think there'll be deflation, but then I think there's going to be some inflationary activity. And why I see deflation happening is more so due with the psychology of the average saver, the average American, as opposed to it solely being tied or mostly being tied to the commodities. So we both see deflation. I see hyperinflation. After that, he sees a continued deflation, and he sees deflation because of commodities, and I see deflation because of the M2 money stock. And I will show you some data as we go on. But before we go into that, I want to give you his argument for gold being tied to the commodities. So I wrote down some of what he said in this interview with Kitco. So this is a quote from Harry. Gold doesn't correlate with the modern economy. He then goes on to say, gold is a premier commodity. It goes up and down with the commodity cycle. Guess what? Commodity cycles peak every 30 years. 1920, 49 to 51, double top. 80, almost every commodity topped in 1980, including gold and silver, and then crashed. And now, 2008, agriculture, energy topped, and then the metals peaked in 2011. Gold was the last one in September, and it's been in a crash ever since. Now, again, this is in 2017 when he says this. Now, you know me. I've been saying since 2015, we've been in another gold bull market since the beginning of 2015. And as you know, gold prices have slowly risen since that point. So I have no idea back in 2017 why he would say gold was crashing ever since 2011. So let's go back and take a look at some of these periods of time that he calls out. He calls out 1920, he then calls out 49 to 51, he then calls out 1980, and then 2008. So let's start to look back at those times and see where the price of gold was relative to commodities. So he says commodity cycle peaked in 1920. Let's see how things looked back then. So in 1920 for gold was at $20.67. And it looks like gold was at $20.67 prior to that for a long period of time. It looks like it didn't pop or peak along with the commodity cycle that he calls for 1920. Even after 1920, it looks like it was still $20.67 for the price of gold. Now, let's go back even further. So let's go back to 1879. So from 1870 or 1878, it was $20.69. But at 1879, it was $20.67. And from 1879, pretty much until 1933, we have gold being roughly at $20.67. And I don't need to do that subtraction. I don't need to do that math for you. 1933 minus 1879 does not equal 30 years. Remember, he said 30-year commodity cycles. So 1933 minus 30 is 1903. Let's go back to 1903. And wouldn't you know it, it's still $20.67. So I have no idea where to begin with that one for him. Or actually, let me go back to 1920 minus 30 years. That will be 1890, $20.67. I don't know where to begin with him with that. Shouldn't we have seen a spike here as well? So that to me doesn't hold water. Let's go to 1949 and 1951. He said there's a double top in the commodities. So 1949 and 1951, gold in 1949 was $40.50. 1951, gold was $40. So before that period of time, in 1947, gold hit its peak at $43. It was actually rising up until 1947, hit $43, and then it started to slowly go back down. So that to me doesn't necessarily correlate with a double top in the commodities in 1949 and 1951. As gold was roughly $40 then, but its height was in 1947, and it only happened once, not a double top. And also, as we know, in 1980, gold peaked. Let's take a look at that. Gold peaked. But gold peaked due to rising inflation and other economic data that played into it. It wasn't because it wasn't solely or for the most part at that price because it was a part of a wave of commodities. It was primarily economic data supporting that. And in 2008, another number that he brings up. Let's take a look at these numbers here. Actually, let me go to a graph of gold. So this will give you a better understanding of what happened during that period of time. So we have gold actually dropping in 2008 when he says there was a commodity boom. And then he rightfully stated that in 2011, gold did hit its top. But the reason for that is because of, in 2008, it dropped along with equities in deflationary activity. There's a drastic cut in the velocity of M2 money stock, but then it rallied from inflation again, along with weak real interest rates. So to me, gold is still tied to the economy more so. And let's take a look at some commodities along with gold against the S&P commodity index, the S&P GSCI. So take a look at this. This is from early 70s up till now. Basically, you see a rise up here in 2008. As he mentioned, there's a peak in 2008, and then now it's just been slowly crashing. The commodities have been slowly deflating. So let's take a look at some other commodities. Here's crude oil. Crude oil hit a peak in 2008. Obviously, you know where crude oil is now. It's been coming down. Let's take a look at soybeans. In 2000, where's 2008? 2008 hit a top, but then hit another top in 2012, but it's slowly been coming down ever since. Let's take a look at lean hogs. Lean hogs. Where's 2008? 2008 is here. It actually hit a peak up here in 2014-ish, and it's slowly been coming down. Let's take a look at copper. 08 hit a top, came down, went back up again in 2011, but has been coming down. Let's take a look at aluminum. Where's 2008? 2008 is right here. Hit a crash, came back up, came back down, has been going up, but generally trending down. Let's take a look at silver. Silver had its peak in 2011 along with gold, and then has slowly been trending downward. I do think it will be rising along with gold. But as you know, silver has more economic factors related to commodities than gold does. A lot of the factors that influence pricing for gold rarely, there are hardly, there's maybe even you can argue one that is important enough for it to factor into the gold price, and that could be with supply. Here's gold though. Gold hit its peak in 2011, came down, but now again has been rising in this new bull market. And we are in April of 2020, and we are basically playing with that 1700 spot level. So to me, gold is still tied with the modern with modern economic data, and its price is more so tied with that data as opposed to it more so being tied or mostly being tied to commodity data. Now, here is where Harry and I agree. We both agree that there is deflationary activity happening, but I believe that the deflationary activity is being caused by a lack of velocity happening with the M2 money stock. He believes that the deflationary activity is going to be happening because gold is so tied with the commodities. Now, if you take a look at what happened in 2008, there's a drastic fall here. Now, obviously, we know that there's in 2011, there was inflation that helped produce weak negative real interest rates for gold, which helped it to shoot up. But ever since then, ever since the recession, people have been generally psychologically holding money and not spending it as much as they had been before. Definitely not as much as they had been prior to the dot-com bubble. So people have been holding on to money, and we haven't seen the velocity this low in recent history. My dad was born in the 60s, and, he hasn't seen velocity at this level before. So we have to go back generations before we can actually talk about when the last Americans had seen velocity at this level. So I believe that once the inflation starts to shrink, and right now inflation in the CPI is at 1.5. I believe it's probably going to go down even lower. We are going to get soon, I believe, positive real interest rates. We're already at negative 1.5. I believe it's probably gonna edge up even more, especially with the nominal rates being just above zero. Shouldn't take too long for that to happen. Once that happens, we're gonna have definitely deflation. I mean, that's deflationary activity. If you have zero, if you have negative inflation, you are in deflation. So I do believe we're going to have some deflationary activity, textbook. And once things start to reopen, and once the psychology shifts in the populace, then we will see an inflection point. It'll go up, and then that's when we will then start to see all this kindling, all this money printing, all of that being set on fire with hyperinflation. So that's my opinion. How do you guys see it? Let me know in the comments section below. This is Black Bullion. Please like the video. Please subscribe to the channel. If you're new, please share the video to help out this economic evangelism, and have a good one.